Bull Runners? Welcome back to the channel. So hopefully you guys can hear me loud and clear. Give me a 777 in the chat if the audio's coming through. We are on our way to someplace very special right now that I'm going to be sharing with you guys soon. But we got some big news because it's happening with Coinbase. Coinbase just revealed the launch of its new Base blockchain. And although this is not new news, I have some powerful information to share with you guys about what this means for XRP, what the Federal Reserve is doing, what the SEC is about to do, what BlackRock is doing as well too. And so what Base is, it's a Base blockchain. It's often referred to as a layer 2 network. And so layer 2 solutions are designed to scale and improve the efficiency of existing layer 1 blockchains like Ethereum. So these solutions operate on top of a layer 1 blockchain and process transactions off chain in a more efficient manner before settling the final results on the main chain. Now I know that might not make any sense for those of you that haven't been around crypto for a while, and I get it, sometimes it can be even confusing if you've been in crypto for a few years because all this new terminology coming out there. And some examples of layer 2 solutions for Ethereum would be like optimistic rollups and ZK rollups, but there's also the Lightning Network for Bitcoin, there's Polygon, there's IMX, Loopring, and tons of others. So how will this affect the crypto market, and why is this important for XRP? Well, here's a simple analogy. So I can explain this to you guys in a way that everyone would understand the difference between layer 1 and layer 2 in the world of crypto. Now, for the layer 1, so imagine right now, okay, imagine with me for a second, you're at a restaurant. You're at Prime 112, you're at Nobu, you're at Komodo, okay? This restaurant, it's the big bustling place where all the cooking, the serving, the networking, the fine and dining, eating, the business meetings are happening, okay? It's hot, all right? The streets understand that when you eat here, you eat at these restaurants, you're not just another customer that's, going to some basic restaurant. You're a piece of art, okay? You're a real life walking Michelangelo, okay? You're a stud muffin, okay? That's what you are when you eat a fine restaurant. So this is your layer 1. Just as the restaurant is the main hub for all the food activities, a layer 1 blockchain like Ethereum or Bitcoin is the main hub for all the transactions. When you hold one of these, you're considered not just a crypto degenerate that's YOLOing all your money into a meme coin, you're considered a sophisticated investor of the new era, okay? That's what it is for layer 1. Now, let's talk about layer 2. So imagine that you go to a restaurant and they allow a special food delivery service like Uber Eats or DoorDash. When you use these services, you place your order. Instead of cooking your meal right there in the restaurant, they prepare it in a separate, faster kitchen specifically for delivery. So this service is like a layer 2, and it helps the restaurant handle more orders quickly and efficiently without overcrowding the main kitchen for customers that want to dine there in person. So you basically get the same food without needing to put on your nipple pasties or squeeze that iconic dad bod you got back into those dress pants that you used to fit into in college with that button-down shirt that shows, the pit stains when you get too loosey-goosey and out of control on the dance floor, busting out those breakdance moves that you used to have back in college after you eat your sloppy steak for that business meeting at Nobu, okay? So you want to order it at home, you want to eat at home in your sweatpants, you want to watch your Netflix and chill, and you just want a nice meal without having to go out there and put on the whole wine and dine show for those fancy business meetings. So similarly in crypto, a layer 2 solution is like the faster, more efficient kitchen like Uber Eats or DoorDash for transactions, all right? So instead of putting every single transaction directly on the main blockchain or the layer 1 restaurant, layer 2 solutions process many transactions off-chain in a separate kitchen to order to go. So this helps the main blockchain handle more transactions faster at lower costs. And the reason why this is important is because after tons of testing by developers, Base has now opened its doors to the public, marking the dawn of a new era for public companies independently operating distributed networks. And so this innovation could enable Coinbase to not only generate fees from its blockchain, but also tap into potentially substantial revenue from applications built on top of it and bring even more investors to the table for Coinbase. And layer 2 networks like Base are alleviating congestion on the foundational network. And Base is built on Ethereum's blockchain using what's called the OP stack, which is an open source framework by the Optimism team to create Base. And so this framework is popular amongst L2 developers for deploying optimistic rollups. And that's going to further the use case of Ethereum as well too. And although Base is separate from Optimism, the use of OP stack ensures a high level of interoperability between the two. And unlike other L2s, Base doesn't have its own dedicated token, which is possibly due to, Coinbase's support, the absence of a token incentives for locking assets on Base aligns with its goal to remain closely connected to Ethereum, and also could have to do with the SEC suing them for listing unregistered securities. So they might not necessarily want their own token, and they would want to fuel trading volume so they earn from the fees on other tokens as well too, and get those tokens excited about working with them rather than thinking that they're just going to try and take the market share for their own token through Coinbase. So funded by Coinbase, Base was initially intended to power Coinbase's products, obviously, but it aims to create an open ecosystem for various applications beyond the exchange's scope. And similar to Binance's BNB chain, Base seeks to leverage Coinbase's brand recognition to attract more users, since Binance is dominating the international market. Coinbase, they've been stifled in the United States, and the majority of their customers were in the United States, but Binance is able to operate overseas, and they've just been dominating that. While some people are criticizing Base for being associated with a private corporation, its roadmap includes plans for decentralization. And so the current sequencing is managed by Coinbase, but the project aims to transact governance towards a more decentralized model. Now, Base is supporting account abstraction, allowing users to interact with the network without directly owning the underlying account. And this is big because it enables third-party accounts to execute transactions on behalf of their users, enhancing usability and reducing concerns about gas fees and private keys, which has been a big issue through, if you're using MetaMask to transact with Ethereum. During the peak of the bull run, gas fees were, to do anything with NFTs, they were like $200, $500, sometimes upwards of $1,000 to make one transaction. If you had $50 of Ethereum and you wanted to send Ethereum, sometimes it cost you $50 to send the Ethereum, which is crazy. It's stupid. It costs more than a wire transfer, even though you got it almost instantly. So this is going to be a massive development in the space, and Base's upcoming launch as an Ethereum layer 2 blockchain is noteworthy due to its use of OP stack. So in absence of a native token, a broader ecosystem aspirations, commitment to decentralization, and support for account abstraction is what's going to make this newsworthy, and everyone's going to be talking about this. But even with this news, it's still not enough to move the markets, and people are wondering what's going to cause the next massive bull run. Well, in July, the CPI report came out, and it rose by 3.2% compared to a year ago, indicating that inflation is slowly loosening its grip on the economy. And the data indicates that inflation is moving in the right direction, even though inflation came in higher than the previous month, which could impact Federal Reserve policies and interest rates and all that. It suggests that while inflation is still above the 2% target that they have, it might not require immediate interest rate cuts. And as Jerome Powell said, they're going to keep raising rates until inflation is under control for an extended period of time. So what I'm expecting is not financial advice or anything. Obviously, you understand that. You're a full-grown, educated cryptocurrency degenerate here, but I'm expecting more rate hikes this year. And so the report led to a positive market reaction, with the Dow Jones Industrial Average and the futures rising, and Treasury yields are mostly lower, but consumers are using credit cards and they're saving more for spending. Credit card debt surpassed $1 trillion. So this is suggesting that people are adjusting their spending habits in response to rising costs. And also, student loan forgiveness program is ending, so a lot of money is going to need to flow to student loan payments. And so that's what's causing a blockade on the crypto market right now, because with newly graduates, college students that have student loans, well, those are the vast majority of people that in the retail market that were putting money into crypto, right? They saw the meme coin craze, the stonk craze, GME, Dogecoin, Shiba Inu, Bitcoin, Ethereum, everything happening in the crypto space. So they were YOLOing money in, and now they're gonna have to use that money to pay off their student loans. And speaking of student loans, I don't have any student loans because I'm an idiot and I dropped out of college. I'm a degenerate, but Amanda's very smart. She actually finished college, she got her degree, but she took out a lot in student loans, and the forgiveness program ended, what was it, September 1st? September 1st. So September 1st, and the interest on the student loans were what?
Mine are 7.6%.
7.6%.
Come back in, yeah.
And so if she didn't make any payments, well, because they had the forgiveness, for those of you that don't have student loans, you weren't required to make any payments, and there was going to be no interest until recently, September 1st. If you don't make any payments, then how much did you take out in student loans? What was it?
For PA school, and I stayed home, so it was much less, but $100,000.
$100,000. So 7% on that for the year would be $7,000. So if she just let that sit there and didn't pay anything, she would have to pay $7,000 to the government. And so if you're just holding money in a bank account and you're not putting that to work for you to generate passive income, to generate interest, to offset that, not only is the 7% interest that she would be paying to the government to pay off the student loans, but she would have to pay inflation interest as well too on the dollar, which is 5, 7, 10%. So you're getting, for anyone that's taking out student loans, you're getting completely hosed because it's unforgivable, right? If you die, you have to pass it on to a family member. So the government, they do that to trap you, to completely lock you in, which is screwed up. And that's why it's so important more than ever before to do what? Back up the truck. Back up the truck. Economists are becoming more optimistic about avoiding a recession, though, due to recent forecasts for major financial institutions. So in essence, the CPI data indicates that inflation is showing signs of moderation right now, influencing economic policies, wages, and consumer price and consumer spending habits. And since April of 2022, the Federal Reserve has been lowering their balance sheet through quantitative tightening, or QT. So if the Fed continues to tighten on its balance sheet aggressively and it raises interest rates significantly, it would lead to a flight of capital from riskier assets like crypto to more traditional investments that offer higher yields with less volatility like government bonds. So the challenge here is that the higher that the Fed goes in raising rates, the more it could impact economic growth and investor sentiment. And if the more that they tighten their balance sheet as a result, the Fed might find itself needing to intervene to support the economy time and time again, as they've done in the past, which they could add assets to their balance sheet again. This is a process known as quantitative easing, or QE, to inject liquidity into the markets and stimulate economic activity. So this type of action is the potential, right, to pump more money into the financial system, which would benefit crypto. So they had to do that back in March to help the banks, which was caused by the bank runs, right? When the bank runs were happening, and that caused Bitcoin, when they added, to their balance sheet, it offsetted months worth of tightening. Well, that caused Bitcoin to go from $19,000 to over $30,000 because nobody trusted the banks. And that, combined with the Fed adding to their balance sheet, created the perfect storm for crypto. And so the Fed was backing up their truck, and so was everyone else. And the head of the Treasury, Janet Yellen, she then came out and said that the US was about to hit the debt ceiling, and last minute they decided to suspend it with legislation saying the statutory limit on federal borrowing will be suspended until January 1st of 2025. So what that means is the last time the United States came this close to the default, right, on their debt to pay their bills was back in 2011. That standoff hammered the financial markets. It led to the first ever downgrade of the government's credit rating and pushed up the nation's borrowing costs. And, Fitch downgraded the credit rating to I believe it was a AA plus from a AAA. And so what this means is that until 2025, the government can basically borrow as much money as they need within certain restrictions, but essentially they can do whatever they want to pay their bills, but at the expense of the American people. So that's bad news for the US dollar. That's bad news for the spending power. If you're just saving money in a savings account and you're just hoping that the spending power of your dollar is going to keep going up in value, the more that you save, the more that you're going to lose over time. That's a fact. But this is good news for crypto holders long term. And that's why I'm more bullish than ever before over the next 2 years, because they're suspending it for 2 years. So they're just going to keep adding money to pay off their debts. And the government and the Fed is just going to be able to do whatever they want. So the SEC also just extended its evaluation of the ARK 21 shares Bitcoin exchange traded fund ETF application. So this is a significant decision that aligns with its ongoing scrutiny because the SEC has been blocking applications from major players in traditional finance like BlackRock and Fidelity. And so in a standard practice, the SEC has opened the door for the public input on the ARK 21 shares ETF application. So this is a move that inherently prolongs the verdict by several weeks with a predetermined window of 240 days. To finalize this decision after initiating a review, the SEC is allowing a 3-week window for the general public to express opinions on the proposal. And so additionally, there's an extra 5-week span for responses to these initial comments. And I'm going to explain why this is important, this 240-day time frame for this, because this filing contends that the CME Bitcoin futures market holds regulatory significance and emphasizes that manipulation concerns previously raised by the commission have been mitigated enough to be outweighed by investor protection issues. that would be resolved through the proposal's approval. So ARK Investment Management and 21 shares, having pursued ETF approval back since 2021, since the peak of the bull run, they resubmitted the first potential Bitcoin ETF application earlier this year after the SEC dismissed a second attempt. So the SEC's historical stance has been to reject spot Bitcoin ETF products due to concerns about potential market manipulation, insufficient consumer safeguards, which we know is BF. It's complete BS, right? Because, after the Ripple versus SEC lawsuit and simultaneously the SEC allowed FTX to happen, they're not concerned about safeguarding investors. They're concerned about protecting private investors behind the scenes and protecting, themselves and having power over the industry is what they want. So should an ETF receive approval, it would grant the wider public access to trade and holding Bitcoin's value without needing to directly possess the digital asset, which is massive. Even though paper trading Bitcoin is not necessarily like the best thing, it is massive. And in my opinion, it's not a matter of if, it's a matter of when. And when it happens, you better have your seatbelts on, because the truck's backing up all the way to the bank and institutions are getting ready. And Kathy Wood, who's the CEO of ARK Invest, anticipates a delay in the decision on our firm's application though. So we're patiently waiting because she believes that the SEC will ultimately green light multiple applications, suggesting that the differentiation will come down between marketing, communication strategies, and then ultimately end in approval. And with the spot ETF, you actually have to back what you're allowing people to trade. So they have to have custody of Bitcoin, which would create a massive buying frenzy. So BlackRock would be flowing in massive capital, and BlackRock's ETF approval could mean a wave of institutional investing following into the crypto industry, which in turn, getting into XRP, it would affect XRP due to more liquidity in the market, because it's obvious that with a positive outcome of Ripple versus the SEC, XRP being declared not a security, XRP couldn't even get to $1. So because XRP couldn't even get to $1 with that, what's holding it back? Well, it's liquidity into Bitcoin. It's Bitcoin getting the green light. When Bitcoin gets the green light, guess what else gets the green light? XRP, because Bitcoin and XRP are the only two cryptocurrencies. XRP is the only altcoin that has clarity. Ethereum is kind of in a gray area, but Ethereum's the next one because of the William Hinman speech saying that Ethereum is not a security. So the SEC would most likely not go after Ethereum because William Hinman kind of screwed that up for them. So right now, timing is key with the Bitcoin halving event looming on the horizon. Bitcoin halving is going to happen around April 26th, 2024. So it's very interesting how the predetermined window of 240 days for the SEC to finalize the ETF decision after initiating a review, well, the halving is 259 days away. So it's around the exact same time. It's after an ETF approval, and historically, after Bitcoin halves, what has the price done? It's gone up, right? So when we saw gold in 2003, the first gold ETF get approved, after 2003, gold rose over 500 to about 700%, and gold went on a massive bull run. So could crypto do the same thing? I'm not guaranteeing that the price of XRP, Bitcoin, or Ethereum or altcoins are going to rise based on this. So don't buy, don't sell anything. But either way, what I'm doing is backing up the truck all the way to the bank, grabbing the bags, packing them, stacking them, leaving no bags left behind because the dollar is going down in value. That's a fact. And together, we're all going camping on the beaches of the moon. I will see you on the next video. I will see you on bullrunners.com. As always, you know what to do.
Stay bullish.